Your mortgage renewal could cost you thousands unless you know this. I had the privilege of sitting down with Mac Phillips, an award-winning mortgage professional with Dominion Lending Centers. I asked him questions that you would want to know. Things like the mortgage mistake most Canadians are making right now, fixed versus variable versus adjustable mortgages, and which one's best, the Bank of Canada pressing pause on lowering the interest rates, why chasing the lowest interest rate on your mortgage could cost you more, how to unlock the equity in your home to either purchase more real estate or take a splurge, buy a car, go on vacation, and the new rules that affect mortgages and the new opportunities that come from that. If you are interested in any one of those things that I just mentioned, stay tuned for that and so much more. Hey, I just want to thank you for joining me today. If this is your first time seeing me or you don't even know who I am, my name is Odane Harding. I'm a real estate professional with Royal LePage. And today I'm really excited because I have a special guest, Mac Phillips. Let everybody know where you're from, what you do. We've worked together in the past, so I know who you are, but yes,
100%.
Let the viewers know.
Yeah. Honestly, I was pumped when you reached out recently, Odane, to have me a part of this. So thank you, my friend. It's a very important conversation that we're going to have today. But my name is Mac Phillips. I'm a mortgage agent, if you will. I know often we use the term broker, but I'm a mortgage agent level 2, and I work for Canada's largest national mortgage brokerage company, Dominion Lending Centers.
Awesome.
So local to the GTA. My office is in Mississauga.
Okay.
Yeah.
Cool. I haven't been to Mississauga in a long time.
It's changed greatly over the last couple of years, man. Head out to square one, you would not even recognize it anymore.
Okay. I'll have to do that.
Awesome, buddy.
Before we get into it, I have a question. Because if my name was Mac, I would think I'd have a certain set of nicknames. Do you have any nicknames?
Yeah, Mickey D. Mac
okay.
Daddy.
Big Mac?
Big Mac for sure.
Okay.
Depending on how quickly you read my name, because my first full name is Mac Daniel.
Right.
So often people just see MACD and they just default to McDonald's. So a lot of different cool things, but I think I just prefer to go by Mac.
Okay. Awesome.
Yeah.
We'll keep it short and sweet then.
Yeah, no worries, man.
Okay, awesome. So, I know the mortgage landscape is changing very rapidly these days.
Yeah.
So with the recent developments in the mortgage landscape, the impact of the recent interest rate cuts / the last announcement was a rate hold. So how has the Bank of Canada's interest rate decisions influenced mortgage rates and the broader housing market?
I'm glad you asked because, being in the mortgage industry now, I think more than ever over the time that I've been in it, our understanding of economics, not only our own understanding, but how we educate our clients as to what expectations to have, I think that need has become far more apparent. Almost on every conversation we have, unfortunately, we're now looking at things that impact the economy that are honestly outside of our control. It's no longer a conversation about savings and investments and income as much as it has been. It's more about speculation as to where the puck is headed, what's happening with the economy, timing now more than ever is right at the forefront of the average consumer's mind. So thinking of Bank of Canada, the first thing is just the education piece. What does Bank of Canada actually impact? I think often people are thinking that they have kind of like a stronghold over all interest rates in Ontario or in Canada, and we know they only impact the variable, whereas there's actually other drivers for fixed. So I think that thing or that piece of information and education is more important than ever now. But as far as Bank of Canada's hold, honestly, I think we expected it. I think what we have to do is look at it from a perspective of there's a lot of uncertainty around things that are happening south of the border and the announcements of tariffs. And honestly, a lot of the economists didn't think that the tariffs would have lasted as long as they have. So because we're in this tariff war for so long, the Bank of Canada just said, hey, you know what? Let's just take a step back and see how tariffs impacts inflation one way or the other. So, just really quickly, and I think a lot of, perspective that isn't known is there's two ways to think that the tariffs can impact us. The first way is spending grinds to a halt. People think that their jobs are uncertain. Kind of March 2020, if you compare it to then, where it's like, hey, you know what? We're forecasting that I may not have a job, or my husband doesn't have a job, or whatever industry it is that we're in is now become more uncertain. So people are holding onto their pocketbooks a lot firmer. That's one way that it can impact. The other way that it can impact, honestly, is it can create spending. And I think a lot of people are like Mac, I kind of, make that make sense. Well, think of when we thought the world was coming to an end. What did we all do back in March 2020? We went out and purchased things that we didn't need and more of, and our garages became toilet paper and tissue and soap and all of these things that they were looking to essentially, prepare for worst case scenario. That's happening now because if there's tariffs on future goods, what are you going to do? You're going to try to purchase those goods now, so you don't have to then pay more for them in the future. So because there's this battle between my pocketbook needs to be held and I need things to be more affordable or want to purchase them while they're affordable, we're in this kind of tug of war. So the Bank of Canada said, you know what, let's take a step back. Let's see what the impact of the tariffs are going to be and revisit this in June when the next announcement is. So hopefully in June we'll still see interest rates come down, but that's why they held. It's essentially taking a step back and saying, let's just see what the effect is before we overstimulate or understimulate the economy.
Absolutely. And I've heard two stories this week. One last night at a restaurant where the bartender, who also does the stocking of the shelves in the restaurant, he said when they announced the tariffs the first time, they went out and bought a lot of liquor from America because they thought, it would go up in price. And LCBO stopped selling it as well, right? And then again, with the second announcement, they went out and restocked again. They didn't need to. So now they have overstock. And there was another industry, I can't remember, but the U.S. was buying from a Canadian company, and they over-purchased because they don't want their cost of goods to go up. So
that's inflationary.
Yes.
That is inflationary. The interest rates will never come down if there's increased inflation. So that's honestly what it's created, unfortunately.
Right.
Yeah.
A lot of uncertainty. I say people are...
You've seen
100%. 100%.
Awesome.
I say people are terrified, so... Yeah, that's where we are right now.
Yeah.
Yes. Okay, so a lot of people have purchased homes in 2021, 2022, at the beginning when it was hot. Mm-hmm. And with that comes a significant amount of mortgages up for renewal very soon. So in the coming years, what strategies should homeowners consider to manage their potential payment increases?
Yeah, good question. So the way that we're firstly tackling this is often when there's a renewal coming up, we only look at the renewal options and say, based on the data in front of us on the page or on the screen, what solution should we take? Now it needs to be more visiting, how have you managed for the last year or two? How are you managing your consumer debt? How are you managing your cash flow in your household? What's the plan for your house? Do you plan to sell when the market stabilizes? It's honestly more of a fact-finding, almost like we're back at the initial phase when we're looking to pre-qualify a family and learn everything about them at that point. It's that detailed in the approach to prepare for the renewal because there's honestly so many different ways that we can tackle it. Few things that we can consider. If the plan is to sell the home, well, then we need to prepare for a mortgage solution that's going to allow you that flexibility. Are we selling and getting out, or are we selling and downsizing? Very different solutions that we want to consider in that perspective. Okay. The other one is, how are you doing with your consumer debt? And this is actually something that we're doing proactively. We're not even waiting for renewal anymore. We're reaching out to clients and saying, hey, how are you managing? Are you then pulling from Peter to pay Tom and now having an issue either maintaining your mortgage or worse yet, stacking up unsecured consumer debt because the cash flow in the household is then restricted? So do we need to refinance out and pay out debts? Do we need to maybe not worry about the debts because you've been good there, but then stretch the mortgage back out to 30 years to bring down the monthly payment? Those are the things that we need to understand, and it really comes down to how much we know about our clients and our customers to ensure that we're giving real advice, not just saying pick the cheapest rate. We're way past that being the best way to go. It needs to be about strategy and advice. And honestly, coming from a business perspective, while I don't enjoy the unsettled market, while the turbulence is certainly not welcomed, it does create an additional need where strategy has become more apparent and important than ever. When rates are at 1.5%, client walks into TD, signs on the dotted line, and leaves thinking they've made a good decision. And in that market, they have. But if they simply walk in now, take a 5-year fixed, thousands of dollars can be left on the table. So it needs to be more strategy, it needs to be more advice, and it needs to be rate focused. Now more than ever.
I got you. So more of a personalized approach these days. And okay, that makes sense.
100%. And remember, it's very competitive. Like there's 15,000 mortgage brokers. There's 70,000 realtors. How do you rise to the top and actually are perceived to add value? It can't be rate. It can't be rate sheets. You know what I mean? It has to be more than that.
Absolutely. Thank you for that response.
Yeah.
Okay. Now, can you explain the recent policy changes that make it easier for borrowers to switch lenders upon mortgage renewal and how this benefits homeowners?
Yeah, 100%. So one of the things that we realized or that the government realized, and luckily so, was that so many families were qualifying at different times in the market. And often what happens is that people, when they're qualified for a certain amount, and that's the max budget, most people spend right up until the tipping point. So what that means is that as the qualification changes for the average family, you now are qualified for more home than you can afford in the current market. Just kind of visualize that. So it has everything to do with the stress test. So let's say that you qualified when the stress test was 5%. You bought at the top of your budget. Now the stress test is at 7%. So that means if you wanted to buy that exact same home today, you wouldn't be able to, which means you actually don't qualify for the mortgage you already have. Okay? Not a good feeling.
Crazy.
Especially not at renewal when you want to shop the market again. You're like, well, I know I don't qualify for this mortgage. Am I stuck with this bank? Am I stuck with this lender? So the government and everybody said, you know what? That's not fair. We know that you are, at least you were qualified at some point, and you were qualified on the stress test. So technically, even though the stress test has gone from 5 to 7, you can still afford it because that's how we prepare. We should allow you to shop the market and allow you to remain competitive. If you want to move from BMO to TD and you honestly want to leave BMO, you shouldn't be restricted to do so. So what they did was they removed what's called the stress test from insured switches and conventional switches. So when I say remove the stress test, what that means, it doesn't mean that there's no qualification metric anymore. It doesn't mean that. What it means is that it's going to go back to the good old days. That you were qualified on the interest rate that you received. So if you got a 4% rate, you were qualified on 4%, Bob's your uncle. Now it's 4 plus 2, so you're qualified on 6 essentially. So what they've done is the vast majority of lenders, they remove the 2% premium, they qualify you on the interest rate that you're given. So you still have to qualify, it's just it lowers the barrier of entry drastically. So if you're an insured borrower, you have options. If you're a conventional borrower, you have options to move at renewal. As long as it's a switch, refinance where there's new money, but just lateral. Pick it up, move it to a new bank.
Right. Okay.
Yeah.
Okay. So that doesn't apply for refinancing. So there's not much you can do in terms of, I guess, getting cash out to invest or anything like that. It's
not if the stress test is an issue.
Right.
If the stress test is an issue, you're going to have to move the business to the new bank, optimize that solution, and perhaps there's a different lender that's going to help you with the consolidation. Maybe there's a second mortgage or a different line of credit that'll help bridge that gap. But if we're thinking, hey, you know what, just how do we optimize this loan? Maybe the family's in a good position where they don't need debt optimization or different things. We can still move the business from bank to bank and help you do that.
Okay. Awesome.
Yeah.
Awesome. Now, with various mortgage options such as fixed rate, variable rate, adjustable rate mortgages, how should a buyer determine which product aligns best with their financial goals?
Beautiful. It has everything to do with risk tolerance. When we're having a conversation with a family, I want to treat your mortgage investment very similar to how you would think of stocks and bonds and GICs and mutual funds. If you put yourself on the scale of low risk, medium risk, and high risk, where would you position yourself? And often people don't know how to answer that. Just at face value, they're like, well, I don't really know enough about investing to know my tolerance. So then now we have to ask more emotional based questions like, hey, if you're someone who woke up tomorrow and the interest rates have gone up, would that create anxiety? Are you someone that if you were in a variable and interest rates went up, would you lose sleep? Are you someone who has an investment portfolio that you check daily? Are you on your Wealthsimple every day looking at the up and downs? Or you're someone who's more of a set it and forget it kind of person? Are you someone who would feel comfortable and gain value, emotional value personally, and feel better knowing that my payment's not going to change? I'm okay with maybe leaving a little bit of money on the table because we know rates are going to go up and down. That's less important than my peace of mind, and I would just prefer to not have the payment change at all. Okay? These are the questions that we need to fact find. Often I make recommendations based on what type of property you're buying and what kind of buyer you are. So let's say you're a first-time home buyer and I've done your budget and I know your cash flow and I know you don't have a whole lot of extra savings. I would say, you know what? Why don't we, for this first one, look at a fixed? Why? Well, I don't want you to be constrained. I don't want us to have to, and you have to watch the clock and call me every month with questions around where is the puck headed, because we're all using our best crystal ball, right? No one knows for sure. So I would say, why don't we give you some confidence and some assertion over the next at least 2 to 3 years, allow you to get used to the sticker shock, because when buying a new house, there's a lot of things that we don't mentally appreciate that come up. Now there's maintenance that we had to pay for before. Now we've got a roof that needs to be replaced. These aren't things that you can plan for and strategize for during a pre-approval. These are unforeseen costs. Well, are you prepared for those? Or is it better just to say, you know what, if you can afford $2,000 a month, take $2,000 a month. I'll call you in 36 months when it's time for renewal and we'll discuss how you've done and what our next steps are. So there's really no one right answer for any family. It's all based on risk tolerance, savings, investments, job growth trajectory. Are you going to get a nice promotion soon? Does your work go up 5 to 10% a year where we can say, you know what, today I don't have a lot of cash flow, but I will in the immediate future? These are all things that we need to understand. And not to throw the bank under the bus by any means, because I love working with them, but that relationship, that kind of conversation is often void at the branch level.
Right.
It's mostly rate, pick the best rate.
Right.
Where we need to be far savvier than that to help the family, honestly, and protect themselves from themselves.
Absolutely.
Right.
And you made a good point there with going into the banks and coming to a savvy mortgage broker like yourself. There's a big difference in the advice that you're going to get and the amount of time that you take to understand what your clients are trying to do and what's best for them.
Yep.
So you're absolutely right.
Did that answer your question though?
Absolutely.
Yeah. Okay. Awesome.
Absolutely. Hey, I hope you're enjoying this conversation that I'm having with Mac and that you're getting a lot from it. And if you want to keep up with this conversation, stay tuned for parts 2 and 3. And if you can't wait and you want more information about what it takes to buy in this economy and in this market, feel free to book a call with me. And you can do that easily by clicking the link in my description and booking a time. Looking forward to hearing from you soon.